Hi and welcome to the Debt Service Coverage Ratio Calculator, also known as the DSCR. I was going to quickly take you through what this does and quickly take you through why it's a good idea to use it. Okay, the idea of DSCR is what lenders use to judge how affordable new borrowing is to your business. So the more than you can understand it, actually the better deal you'll get from your lender. Okay, what it does, very simple, it takes your net profit before tax, okay, and it adds back in non-cash expenditure. So depreciation, that's a non-cash expenditure. Any other non-cash spend, that could be a variety of things. It could be one-off year adjustments, paper entries, etc. We add them back in. Costs no longer necessary. Any costs that are incurred by the business but won't be repeated once the new loan is drawn down. A good example of that is where a company is in rented premises at the moment and they're buying those premises. In which case, for rent, for maintenance, etc., for service charges, they will no longer be necessary because you'll own the property. So we can add those back in. Interest and loan being refinanced, yeah, we're repaying another loan as a result of new one being taken out. We add back in the interest that was in the accounts for the last period. That then gives us a figure which is used then to work out how affordable the loan is. In this box here, we put in the new loan amount, the term loan is over, and the interest rate. Key thing to note here, on the interest rate, the way lenders judge affordability is they won't use the interest rate you're being charged, they'll actually stress it, they'll add an amount to it. So if your interest rate is 3%, work it out on here at 5 or 6%, because the lenders will always add a margin in there. So it's worth doing that yourself so you know where you stand. Those figures then bring into this box here the monthly capital and interest, annual capital interest, and interest only costs. We then move over to here, and this gives us the amount of debt service cover you have, either as a percentage or as a ratio. As a guide, most lenders on a capital interest basis will look for 1.2 or 120%, meaning that your income available to service the loan is at least 120% of the loan costs. Interest only providers will use a very similar measure, but on an interest only basis. So again, you're looking at 1.2 or 120%. Your best lenders and the lowest cost lenders will want a much higher ratio. They'll be looking at 2, sometimes 2.5%. We do see some caution with regard to debt service cover. So the higher that ratio is, the better. The key thing for you is to make sure that the lender understands what is being added back in this column here. Very often, if you leave it for a lender to make that decision, they will miss costs which will no longer be payable, and therefore the amount of money they think you've got available to fund your loan will be much less, and that's where problems occur. So use the DSCR, use it before you apply for borrowing, and use it as a tool when you're talking to your lender. Any queries with it, give me a call, I'll talk you through it, and if necessary, we'll go through lender together with you. So there you go, that's your quick guide to the DSCR, and I hope it helped.